Welcome. I am excited about today's video. We are going to talk markets for the next 45 minutes. I have Jeff here. He's the founder and CEO of our company, Arkos Global Advisors. I'm Sarah. I'm a senior advisor here at Arkos, and it's been a tough year in the markets. For anyone who has checked their 401k or opened their investments lately, you know that there's been a lot of volatility, and we've had a lot of questions from clients. It feels like there's nowhere to hide in these markets, and people are wondering, when are things going to be normal again? So we wanted to take some time to address the top questions that we've been hearing, and hopefully bring a sense of calm and reassurance in the midst of a stormy market year. So without further ado, I'm going to kick it over to Jeff, and we're going to start with bear markets in general. So a bear market, what is it? How long does it last? Let's talk about some statistics there.
Well, Sarah, it's good to be with you. Good to talk to everybody. This really is part of the normal market cycle. Bear markets, which are defined by let's say the S&P 500 dropping 20% or more from peak to trough, happen really almost every 6 years. The average drop in a bear market is about 31% peak to trough. So at this time, we're down, when we're shooting this, about 20% in the S&P peak to trough. Everybody wants to know, is this the bottom? Do we go deeper? You never know until it's all over. So of course, we don't have a crystal ball, but we do have a process for making decisions on when to buy and sell, which we'll get into today. And so I just want to remind everybody, this is a normal process. Again, about every 6 years, there's a bear market. They generally last on average about 11 months. So this one really started, let's say, in December. It's likely to be over by the end of the year. Some of them last a little longer, some of them are a little shorter, but it's probably unlikely to be totally over at this point. So we just want to remind folks of that. Another little stat, Sarah, is that really almost historically, in about the last 80 years, almost 1 in every 4 years on average is down in the S&P 500. So not down 20%, but a negative number. So really, we just haven't seen this kind of thing in a while. We had that big dip in really during COVID, but it was almost like a 1 month bear market. I don't think that counts. We didn't have time to really absorb that. So anyway, just a normal bear markets are a normal part of the market cycle.
Yeah. So common advice in the industry during markets like this, because they don't feel good, let's be honest about that, is just to hold on, bear through it, not to use a pun there, but just to hold on. It's going to pass. Is there other advice that you would give people who are having to weather the storm?
So great question. In a very common one that we get, and most people in our industry, that's the advice they give. We would have similar advice to hold on through the down times. Most of the bull markets last a lot longer and go up a lot higher than the bear market. So it's good advice to hold on, but it can be very disconcerting. So occasionally we have even 40 or 45% bear markets, and those are very difficult to deal with, mostly emotionally, just because God made us to, when there's a party going on, join the party, which means buy high. And when the lion is chasing us, we want to run from the lion, which means sell low. And of course, we're supposed to do the exact opposite, buy low and sell high. So what we've tried to do at Arkos is really just give people a smoother ride. Of course, you're not supposed to make the wrong decision and sell at the bottom and buy at the top, but we're trying to make it easier for folks. A lot of the money we run here is on a proprietary basis where we'll make those decisions, based on our dashboard, our 3 dials dashboard for people. And you're never going to be able to sell at the exact top or buy at the exact bottom, but we'd love to, lighten up closer to the top and be adding closer to the bottom. So we're just trying to give a little smoother ride than just holding on for dear life.
Yeah, so a little bit of an active overlay on top of the typical, which is hold out, don't sell,
right.
don't sell. Yeah,
exactly.
Yeah. So a few hot topics we're going to address, starting with inflation and interest rates. You cannot turn on the news without hearing about inflation. As of this recording, the new inflation numbers just printed. So some questions we're getting in this arena. How high are interest rates expected to go? And do you think that the Fed will be able to curb inflation?
Well, and clients and common listeners to our monthly sort of couple of minute market review will know this 3 dials language that I use, but that's just the filter through which we make decisions and look at these markets. And so we really try to look at the evidence and not form that many opinions. Frankly, we have our opinions, but those are fallible. The data that we follow to make decisions is a lot less fallible. They're just statistically valid decisions that we're making historically. And so when we look at interest rate, we're looking at what's happening. So the Fed funds rate is at 1.75%. There was a CPI print, an inflation print just yesterday at 9.1%. The highest in 40, 50 years. Okay. So, inflation is running hot. So obviously the Fed is trying to raise rates. The consensus is they'll raise them to about 3.5%. So another 75 basis points probably this month, and then another 1%, maybe 2 moves of 50 basis points, something like that, with a peak of about 3.5%. Now, what's very interesting, and this is evidence again, is that the inflation bonds, there are inflation bonds out there that price in inflation. So over different timeframes. So over 5 years, these inflation bonds are saying that inflation 5 years from now will be about 2.5%. That really makes sense to us. So we don't think that inflation is necessarily going to run away forever. It's a temporary phenomenon, but it is going to last a few years and start to slope down over time.
So another big question that we're getting is, will the economy be able to hold up under the pressure of the rising rates?
Very good question. So again, in this sort of economic framework, and we're going to talk about a few questions, I think, about the economy. When we talk about the economy holding up under this rising interest rate pressure, I would contrast sort of 2 things. One is mortgage rates, for example, just as an example of a common thing that's affecting folks. When mortgage rates rise, obviously the same payment on a monthly basis, you can afford less house. Basically, as the interest rate rises, your payment goes up for the same amount. So often real estate prices fall. They're really a financial asset because they're generally financed, and interest rates tend to drive the price. Obviously, there's supply and demand issues, but we're talking just about interest rates and their effect on the economy. So as interest rates rise, you tend to see a decline in real estate prices and things like this. So interest rates are definitely a tax on the consumer. Okay. But at the same time, the consumer's in great shape. And so the statistics we're looking at, which are predicting how the next 6 to 12 months looks in the economy, those numbers look great. 3.6% unemployment. Most everybody who wants a job has one, or if they're looking, they can get one. It may not be the exact job they want, but they can get one. And so 2/3 of the American economy is driven by the consumer. So we're looking at things like sentiment and all of that kind of, the consumer is getting nervous, but we're not seeing enough data yet to get even more conservative in our recommendations. We're already fairly conservative in our recommendations for equity exposure, but we're not saying to get more so. If the economy started to weaken more, and we saw it in the data, we would lighten up even more on equities. But for now, things look stable.
Yep. So interest rates are rising. That's designed to slow down a hot economy. Businesses can't get access to capital as readily. It's going to cost them more. Things like the housing market are probably going to slow down because everything gets more pricey. People can't afford as much house as they could a year ago. But on the flip side, the consumer is continuing everyone's got jobs. Most people, the unemployment is low. And so people are still working. They're still producing goods in order to meet the demand of the consumer, is what you're saying.
Exactly.
So it remains to be seen moving forward whether the Fed can continue to play this game rightly.
Exactly.
Yeah.
Exactly.
Okay. All right, so inflation, interest rates, the economy, another big buzzword is recession. We're hearing that a lot. So what is a recession? Are we in one? Are we going to be in one? Let's talk about that.
Yes. So the common definition of a recession is 2 consecutive quarters of negative GDP growth. We did have one in the first quarter for some technical reasons. Doesn't look like we'll have one in the second quarter. So from that definition, we are not in a recession. Of course, you turn on the TV or read the paper, and that is the common thing. You have one bank president say, we're probably in a recession right now, and the next one say, we're not quite in one yet. So, the technical definition of a recession in the United States is set by a board of economists. And frankly, we're not at Arkos, we're more concerned with running client portfolios, and we're not as concerned with the trailing economic indicators as we are at the leading economic indicators and what's coming down the pike. So the kind of stuff that we're most focused on are things like manufacturing orders. So when a company gets orders for goods and they start to make them, well, as we know, as a couple old recovering accountants, they're not yet sold, right? So they can't book those earnings or revenue until those things are sold. And so we think, looking at things like manufacturing orders, we can see what earnings are going to look like and what the economy is going to look like 6 or 12 months in the future. And while those orders have been slowing, they're still positive. So from what we're seeing so far, the economy's holding up, and that for our dials are valuation, basically technicals and economics. Valuation and technicals are off. The only one that's not off yet is the economy. And again, we talked earlier about the consumer being 2/3 of the economy. The consumer is hanging in there. So these economic numbers are weakening. We're not really that concerned about whether we have a recession or not. The Fed says there's about a 35% chance that we'll see a recession in sometime in the next year. That's less relevant than, frankly, what do the markets do? And that's what we're trying to get ahead of. If we see these things weakening some more, we'll lighten up on equities. Right now, it's stable, and we're not.
Mm-hmm. Okay, so let's shift a little bit. That was a lot of heavy conversation. But there are some folks who are actually looking to take advantage of this market. So we talked about, everyone wants to sell at the top, buy at the bottom, easy to do in hindsight, hard to do in the moment. So people who are looking to take advantage of the bear market, who have cash on the sidelines, what advice would you give them for when and how to buy into this kind of a market?
Okay, now there's kind of 2 ways to look at this. There's the real world that you live in with client advice, dealing with clients every day. And then there's the sort of math nerd in me. And I'm thinking of our investment committee who we address this question a lot. And statistically, the right thing to do is to simply hold a certain amount that's your emergency fund. 6, 12 months, whatever your situation dictates. Some people have more stable situations and they can maybe have a shorter term emergency fund. Other people maybe have a volatile business that they own or something and need more cash on the sidelines. We understand that. But every cent beyond what you need for your emergency fund, or maybe that you need in the next couple of years for an expense that's coming down the pike, that's the world you deal with in doing these financial plans. Mm-hmm. But for the longer term money, stuff that's beyond 5 years, the statistics always say just invest it. Okay. Mm-hmm. And what we would say at Arkos is, let us have it to invest. Don't hold all that cash trying to kind of time the market. You may not be thinking you're doing that, but you're really timing the market by not letting us invest it for you. And then what, of course, you do with the rest of the client advice team is come up with kind of a risk score for everyone. Mm-hmm. And then there's a band around that risk score, mm-hmm, that allows us to take a little more risk when we think things are cheap, or take a little less risk when we think things are expensive.
So let's move now. You mentioned a moment ago, people who strategically moved to a more conservative allocation, maybe swapped out, got rid of some equities, bought some bonds. They're in a defensive position. When is it time to get back onto the offense, get back into equities and begin to ride that upswing? How do you tell?
I love it when this discussion comes up because that means people have the right attitude. I always joke that we're the only business in the world when we have a sale, nobody shows up. Okay, so when we get questions, which I love, about people saying, "Hey, market's down 20%, should I be adding?" You know, yes. As we just addressed a question about if you have cash on the sidelines, always get that to work if it's not for other purposes in a short term, and let us kind of allocate the risk would be my suggestion. But once the money's in, or you do get a liquidity event, what do you do, and when would we see that we should add? So right now, 2 out of the 3 dials are in a defensive position, and the data is weakening a little bit. So we kind of have the technical dial is the quickest moving dial, sort of a 3 to 6 month period. The economic dial, where we're looking forward 6 to 12 months with the economy, it's about a 6 to 12 month look ahead. And then the valuation dial is very long term. We just want to, we'll just hold our, even if those other 2 dials are off and things get cheap enough, we'll buy, but that kind of sets maybe what your return is over 10 years or something. So that's the slowest moving dial. So 2 out of 3 are off. Valuation dial doesn't look like it's about to turn on anytime soon. So that technical fast moving dial is the one that's likely to tell us to take more risk soonest. So yes, put your cash on the sidelines in, but we're not going to add risk for you until we start to see some improvement in that technical dial.
And how long does it normally take? We mentioned a bear market typically lasts on average 11 months historically. How long does it take to crawl out of a bear market?
Yeah. So again, we're talking 11 months on average. So if this thing started in December, this bear market, we could easily be out of this thing by this coming November. Maybe it lasts a little bit longer. Maybe it's a little bit shorter. But it really doesn't take that long if you're just patient with it. And the big thing for us is avoiding the big drawdowns. And this is also mathematical. It helps emotionally, frankly, to hang on if you don't take as big a loss. So when you see these big headlines, at least our clients, they're not down like with the S&P generally, unless they're all equities, which very few are. And they don't want the dials to work for them. But if you have just a 20% decline in your portfolio, it takes 25% to get back. If you take a 50% decline in your portfolio, it takes 100% to get back. So just mathematically and frankly, emotionally, we like to give that smoother ride. We'd rather be a little slower to add back, and we're more interested in limiting the downside and then later catching most of the upside. So we want to do both, but it's just not time. I mean, the data is just not saying this is the time to add. So I love the attitude of doing it. I'm sure it'll work out over a long period of time, but we think we can do a better job of kind of controlling the risk return when the odds are more in our favor, and they're just not yet.
Yeah. So let's go to probably one of the more technical topics, bonds and alts. So typically when some common alts, real estate, gold, fixed income, but the bond market especially is tricky even for seasoned investors to understand and to navigate well. But this bond market in particular is very unique, and it's pretty bad right now. And it is a traditional hedge, and it does not seem to be working for people in the way that it has in the past. So let's talk about the bond market. What do you see happening, and how can people position their bond portfolios in this kind of a rising interest rate environment?
Well, you're right. This is the worst bond market we've had in decades. So that's absolutely true. But even the sort of most commonly accepted US bond index is down less than half of what the stock market is. So, we would love the bonds to be up while the stock market's down, as it happens traditionally, but that's not happening right now. Fortunately, we knew interest rates were historically low. We've tried to position our portfolios to have shorter duration, which means they don't get hit as much. Our bond funds don't get hit as much when interest rates go up. We also had some floating rate bond funds, which means that as interest rates go up, we get paid more interest. Those have performed very well. So we've done better than those averages in our bond portfolios, but they're still down. Pretty much any bonds are down. So that's a bummer. But I think we've seen sort of the peak drawdown in most of the bonds. You got to discern a little bit about what areas. We have some opinions about what's cheap and what's expensive. But just in general, I think we've seen the worst of it in bonds. And we answered a question earlier about where are interest rates going. I think consensus is that they're going to about 3.5%, 3.5, 3.6%. If, and you know, the US government has $30 trillion in debt. They're moving the interest rate on their own debt. I think the likelihood of them raising interest rates a lot more is pretty slim. So if you see, if interest rates do not rise that much, you'll see bonds rally. And even if that's not the case, and they go to 3.5% on the Fed funds, I think you've seen the worst of it in bonds. And so right now, we are way more concerned about stocks. You've seen sort of 2000, 2002, 2008 and 9, 45% type drawdowns in stocks. We're at 20%-ish in the US. You know, it could get a lot worse there if we see erosion in the data. It probably doesn't get a lot worse in the bond market. I know we can talk in a little bit about gold and some of those things as well, but at least for the bond market, that's where we are at the moment.
Yeah. So one more technical question on bonds, the inverted yield curve. There's been some talk of that now. There was talk of it pre-COVID. Typically, an inverted yield curve precedes a recession. And right now, or at least as of July, this month, the yield curve, the 2 to 10 year yield curve is inverted. Is this an indicator people should be worried about? Is it an indicator people should be watching? What are your thoughts?
Yeah, this is definitely for the market nerds out there.
Yes,
Most people
is.
are like, what are you talking about? Inverted what? Are we at Six Flags? So I don't want to go on too long about it. Let's just suffice it to say that we do look at that, actually. We don't make decisions purely on that one number because it has some false signals, and it just barely went inverted, and which it can do occasionally. And then so it gives a lot of false signals, but we do watch it. And if it gets serious, that is a bit of a clue. But again, we have a large dashboard of forward-looking economic data that we look at to make the decisions. And again, we don't see a recession on the horizon right now. But if the data changes, we'll change our opinion. We go with what the data drives, and that data has helped us make very good decisions over the time. So, and just to kind of explain the inverted yield curve, the 10-year treasury, if you will, that basically kind of predicts what economic activity will be 10 years from now. Okay. The short term, sort of 2-year, is kind of, adjust for more where interest rates are today. So what they're basically telling you, if you think about it just logically, is, the Fed is raising interest rates now. So what that 10-year being at, a much lower rate is telling you, or a slightly lower rate, I should say, is that the economy, the Fed is likely to fight interest rates with these higher interest rates temporarily. And as inflation comes down over the next 10 years, they'll lower those rates. So that 10-year treasury is telling you this is a temporary phenomenon where the interest rates are being jacked up, and then they'll bring those down. So I don't think that's a cataclysmic problem, but we are watching it, and it is an indicator, not the indicator of a recession. Yeah.
Well, and I think that's an important note, because a lot of what we talk about is we don't want to have hubris around here, right? We don't want to be 9 out of 10 economists have correctly predicted 1 of the 10. Yeah. Last, it's hard to predict correctly every single time.
Right.
And we talk a lot about having multiple indicators that we're watching and not just one. And exactly. I think that's really important for the listeners. We don't hang our shingle on even one of the three dials. That's why they're meant to work in conjunction with one another. We want to make sure that we're looking across the board at multiple pieces of data and combining them in order to make the best decision moving forward.
Well said.
So to wrap us up, let's end with just other common alternatives: real estate, gold. Gold in particular, again, it's normally a common hedge and it's getting crushed.
Yeah.
And that doesn't feel good. So let's just address that really quick.
Yeah, I think we maybe address the real estate, but we really look at real estate simplistically as correlated with interest rates. It's a financial asset, generally financed. As interest rates rise, real estate prices go down. We know there's supply demand dynamics, just like there are with commodities. But there's some technical reasons for gold as well. I was just looking earlier before we started recording at gold prices in other currencies. It's up in almost every currency in the world. The reason gold's down is primarily that the US dollar is incredibly strong. And if you think about it, it kind of makes sense. We're really the biggest developed country that's raising interest rates the most. When you raise interest rates in a country, you strengthen your currency. So think about Europe. Europe is battling. Germany, for example, in particular, is really struggling with this energy crisis, trying to store up enough natural gas for the winter because of the problems of Russia invading Ukraine. So there is a big energy crisis happening in Europe. The ECB cannot raise interest rates the way the US is. They just can't do it. The economy is too weak. So the dollar is spiking. So it is on just an incredible spike. I was just communicating with one of our friends and clients who's in Taiwan, and he loves to send us pictures of his meals and the prices. And I said, at least he's enjoying the strong dollar because everything's cheap if you're traveling internationally. So I guess that's the silver lining. You got to deal with the airlines, but we think this is a real temporary phenomenon. So gold is up year to date in almost every currency but the US dollar. It's still up better than most bonds and stocks are. So it's doing its job. And I think as the dollar normalizes, it's probably due for some pretty good performance over the coming years.
So this by no means is an exhaustive list of questions that people have about the markets, but these are definitely, as we have talked with the families we serve, as well as just other people in the marketplace, these are the questions that we have heard consistently. And we just acknowledge that making good decisions in the midst of a storm can be very difficult. And it does help to have some guide rails and to have some guidance. And so if you have further questions, of course, we would love to talk with you and address those questions and concerns. In the meantime, you can always be on the lookout for future market update videos. Every month, we just shoot an update on our three dials, as well as just our outlook on the markets. And I think consistently, that's been one of the pieces of information that the families I serve receive that they really appreciate. And so you can, of course, also subscribe if you would like to receive those updates on a monthly basis. Thank you so much for listening. We hope this has been helpful. And maybe if there's enough people who have made it to this far in the video, we'll shoot another one of these. So thanks again for your time. And we hope you have a wonderful rest of your week.
Thank you, Sarah, and thank you for listening.